because they're the ones accumulating it. And at some point, we see the price setting move from the COMEX, move from the LBMA to places like Shanghai, where, by the way, Pierre Lassonde said the price ultimately will be priced in the East, not in the West, when the volume on Shanghai surpasses COMEX. Well, just recently, the Shanghai Metals Exchange and the Shanghai Futures Exchange combined volume is greater than that of the COMEX, making it number 2 most heavily traded platform for gold in the world. So how close are we? A lot closer than we've ever been, in my opinion.
In today's news recap, gold glitters near record high levels after Trump's comments. Gold prices rose nearly 1% on Friday, lingering near record high levels scaled in October, steered by U.S. President Donald Trump's calls to lower interest rates and uncertainty surrounding his trade policies. Spot gold rose 1.1% to $2,784.82 per ounce and was up 2.8% for the week. Prices are at their highest since October 31, when they hit a record high of $2,790.15. Gold's move towards a fresh all-time high has coincided with a correction in the dollar, which is lower following remarks by Trump that suggest he may go soft on tariffs and settle for a trade deal with China, independent analyst Ross Norman said. We see gold is likely to hit $3,175 during 2025. On Thursday at the World Economic Forum, Trump said he would demand that interest rates drop immediately. In an interview with Fox News, Trump said he would rather not have to use tariffs over China. Zero-yield gold is known as a hedge amid political and economic turmoil and tends to do well in a low interest rate environment. Trump's remarks come before the Federal Reserve's meeting next week, where the policymakers are widely expected to leave rates unchanged. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps, and check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
You look at the amount of silver that India's imported, almost 900 million ounces in the last 4 years, as you mentioned. Russia making a part of their strategic stockpile. China is gone from a net exporter to a net importer. They're flying all around the world to Peru and to South America in particular, disintermediating the market and buying directly from the miners. They're buying doré bars, which are a crudely refined bar, maybe 40-50%, before it gets sent in for further refinement. And they're buying concentrate, which is like a sludge byproduct of the mining and the refining process, and sending it all home, paying double what the West will, and having it refined further in China. 77% of all of China's industrial uses of silver is coming from concentrate that they buy directly from the miners, which disintermediates the marketplace. No one knows how much they're getting. It doesn't affect the price. They're the second largest producer of it in the world as well. And here we are again. We'll have a 280 million ounce shortfall this year again, which is the 4th year in a row over 1 billion ounces short. It's a structural deficit that's not going away. You had 47 million ounces delivered off of COMEX in December. Who's taking that? Where's it all going? On the LBMA right now, you have 800 million ounces. It's the lowest position they've ever had, because of that 800 million, 500 million belong to the ETFs. That leaves a float of 300 million ounces. They trade 290 million ounces per day on the LBMA. They trade the entire float. However, they admit to the fact that that trading is 10 times understated because they only post the final settlement numbers, which would mean they're trading as much as 3 billion ounces of silver per day, which is 3.5 times annual global mine supply. They have a 300 million ounce float against between 4 and 6 billion ounces short naked. 90+% of all of those short trades are naked, meaning there's nothing behind it but stupid commercial banks' ability to continue to suppress the price. And that's something that I think needs to be understood because what it is a powder keg waiting to happen. And whether it be a delivery failure or a force majeure, on COMEX, silver is rehypothecated close to 2,000%, meaning 20 people hold a 5,000 ounce contract. If every one of them stand for delivery, one will be lucky to get the metal, the rest would be cash settled or force majeure. You have military industrial complex that needs silver. It is omitted in the supply demand numbers. If you Google H.2768, I believe is the number, that was a congressional hearing in 1942 where they basically they're talking about using silver for war purposes, and they said at the present rate we're using 200 million ounces of silver per year for military. That doesn't take into account the aerospace and the ICBMs. All of these super high-tech military applications need copious amounts of silver. So take a step back and ask yourself, why would 8 commercial banks be stupid enough to have the largest concentrated short position in any commodity ever traded in the history of COMEX on silver? Why would those same banks be short between 4 and 6 billion ounces of silver in London off of a 300 million ounce float? Because they're stupid, number one, as stupid as a mud wall, and number two, they're being told by very powerful people, in particular the military industrial complex, to keep the price low because they need it to make high-tech weaponry to sell all around the world. That's why it's happening. And the difference now is that the countries like China and India and Russia are not only coordinated and sophisticated and motivated, but they're wealthy enough to exploit the delivery mechanism. That is what is different. No one ever stood for delivery. These countries were not motivated nor coordinated to stand for delivery, and they are now. And that's where this ultimately ends. I look at silver as the most asymmetrical risk-reward trade I've ever seen. Lowest downside, best upside. And one of these days, look, the only way that you can successfully manipulate a market over time is to push it in the direction it's going. For a very long time, silver was very easy for these banks to manipulate. But being on the wrong side of a naked short right now in this market, where countries are actually including them into their strategic stockpile, where China is flying around the world buying concentrate and doré, tells me that this game has never been closer to ending. And really, they understand what we're doing, and they're using our suppression against us. It's jiu-jitsu. Use your opponent's leverage against you, and they are. The reason they're not bitching about our suppression is because they're the ones accumulating it. And at some point, we see the price setting move from the COMEX, move from the LBMA to places like Shanghai, where, by the way, Pierre Lassonde said the price ultimately will be priced in the East, not in the West, when the volume on Shanghai surpasses COMEX. Well, just recently, the Shanghai Metals Exchange and the Shanghai Futures Exchange combined volume is greater than that of the COMEX, making it number 2 most heavily traded platform for gold in the world. So how close are we? A lot closer than we've ever been, in my opinion.
In today's news recap, silver to beat gold in 2025, Saxo Bank's Hansen. Diversified commodity exposure should continue to perform well in 2025 as a hedge against inflation and economic uncertainty. Specifically, gold and silver are expected to outperform the sector. Despite the bullish outlook in his 2025 forecast, Ole Hansen, head of commodity strategy at Saxo Bank, recommended that investors be discerning as they build a commodity basket within their portfolios. Gold and silver remain 2 of his top picks after their historic runs in 2024. Hansen said he forecasts gold prices to rise to $2,900 an ounce this year, representing a gain of 7% from current levels. However, Hansen sees even more potential in silver, projecting prices to reach $38 an ounce, a gain of nearly 30% from current levels. He added that his outlook is skewed to the upside. Looking at gold, Hansen noted that the precious metal will remain an important safe haven asset through 2025. The demand for investment metals has been fueled by an increasingly uncertain geopolitical landscape where global tensions and economic shifts have led investors to seek safer assets, a development that shows no signs of fading anytime soon, he said. Additionally, concerns about mounting global debt, particularly in the United States, have prompted investors to hedge against economic instability by turning to precious metals. However, he added that investors will need to be patient as the Federal Reserve shortens its easing cycle. Currently, markets are pricing in only one rate cut this year, a sharp contrast to expectations from a few months ago. The U.S. central bank's hawkish stance could support the U.S. dollar, creating some volatility in the precious metals market. Now we'll show you the best clips of the latest interview, but first, like, subscribe, and turn on notifications. And more importantly, let's celebrate democracy's recent victory in America. We're running a 30% off sale at goldsilvermerch.com until the end of the month. We've just introduced price point t-shirts and new designs, so this is the perfect time to get your gear and support the local economy as well. Use the code PRESIDENT at checkout to claim your discount. Enjoy the episode.
Physical silver is first and foremost, and that's the foundation. That's the base of your pyramid. But there are massive undervaluated and huge values in the mining shares, for sure. And there's only a handful of silver mining shares. I mean, really, truly, in terms of producing companies, there aren't that many of them. So yeah, I would buy a handful of major producers. I'd also buy something like Silver Wheaton, which would be a royalty company in the silver space. And I think that there's tremendous upside potential in the silver equities. But I don't think you want to ever mistake the two. The physical is the physical, the mining is the mining. They're cousins, but after all, the mining shares are derived off of a stock market, which one could argue is the most overvalued stock market ever. So if the whole market collapses, well, it can bring it down. But let's not forget, during the Great Depression, when the market collapsed, Homestake Mining was the #1 performing stock of the entire stock market. So to say that, you know, it may fall at first, but the value found in gold and silver right now in the mining shares is unlike anything I've ever seen. That goes up on the top of your pyramid along with your cryptocurrencies. The middle of the pyramid would be things like treasuries, short-term treasuries throwing off a yield, or utility stocks throwing off a dividend. Base of your pyramid never goes backwards. The middle of your pyramid is something a little more slightly riskier, throws off some return, and the top 10% is the home run. But at the values you see right now in some of these silver equities, that top 10% could outperform the bottom 90 very easily, in my opinion. They're that kind of valuation right now. Silver American Eagle is probably the most sold coin. It's by far, because the premiums came down. The 3 years previous premiums on American Eagle were unlike anything I've ever seen. Double digits worldwide, $15, $16, $17 over everywhere. And now you're able to buy them at $4-ish over, which is still higher than it was most of my career, but much less than it was during the pandemic. So the Silver Eagle has been really the one that I think has got the most attention.
Yeah.
We've seen a lot of selling over the last few months, in particular since Trump won the election, and I think it's irrational. I think it's very irrational. A lot of these people are chasing the risk on trade. It's a mistake. And in fact, as we've seen a lot of selling, we've also seen a lot of very large purchases from, I would say, sophisticated investors who have made very large purchases. But what we have seen is more selling than I've seen since 2017 by the public, most of which are not doing it for any other reason but then to chase the risk on trade. And you have a risk on trade that is wickedly overvalued right now and very dangerous for maybe a potential rug pull.
What are your thoughts on Andy Schectman's interview? Do you agree with his predictions? Do you think the BRICS nations could challenge the US dollar and disrupt the American economy? Could gold really blow up in 2025? Drop your honest opinions in the comments and let the Stacker community know if you're investing in miners or prefer sticking with physical metals. Thanks for watching. Don't forget to check out this video over here. I'm sure you'll enjoy it. I'll see you on the other side.